Good day, everyone. With gold prices making new highs almost every day, we thought it pertinent to share our current thoughts with you and also share some of the interesting charts that have been arriving in our inboxes in the past week or so. I've titled this short vlog A Stealth Bull Market, since this is the fourth gold bull market that I've been through in my career. However, I've never witnessed a bull market that's so ignored by the market with so little appetite out there for the gold shares. The question is this an opportunity for investors or really just a trap of getting into the stocks at the wrong time? I'm not going to say that we know exactly where the gold price is headed in the short to medium term, but we just want to share a few observations that are taking place right now. So compared to 2022 and 2023, the headwinds that face the gold have been turning increasingly into tailwinds over the past 12 to 18 months. The election of Donald Trump as president of the US in November last year was first seen as a negative for gold, as he vowed to cut government expenditure and reduce the country's debt burden. Subsequently, we've seen tariffs as front and center of his policies, which is inflationary by nature and very positive actually for gold. And more importantly, his policies are seen as increasingly a threat to the stability of the global economy, with large institutions as well as central banks around the world looking again at gold as a safe haven trade. Despite the announced plans to cut government spending, the market is realizing that this process will take some time and debt levels could actually rise substantially in the coming years. Just 3 weeks ago, the Congressional Budget Office, the CBO, updated their budget and economic projections and forecasted that the US national debt is forecast to rise by 23.6.9 trillion over the next 3 decades. Over the next decade. This year, close to 9 trillion of debt needs to be refinanced at high interest rates, which will put further pressure on government spending. So it's little wonder that central banks around the world are diversifying their reserves by holding some gold as a proportion of their reserves. Rising geopolitical tensions, especially the threat of confiscation of US treasuries held by nation states, is also leading to central banks' desire to increase their gold holdings. We don't see this slowing. If anything, it could accelerate under the Trump administrations as trust between nations diminishes. Now, key to the short-term outlook for gold is interest rate policy in the US and inflation expectations, which is really the direction of the real rates. The gold market has really been sniffing out for some months that lower interest rates may be politically motivated in order to keep interest payments under control than driven by economic data points. A resumption in inflationary pressures coupled with lower interest rates just will bring the real rate back to zero or below, which is really a positive environment for gold to perform. And finally, maybe the most important aspect, the exposure to gold, either physical or in the form of equities, is currently at record lows. There are a number of reasons for this, the principal being the lack of belief in the sustainability of the gold price itself. But in reality, over the past 10 years, equities are up 200% or more, and even cryptos are up 300% over the past couple of years. So there's been other ways for investors to hedge themselves against inflation. Now, this is a really interesting slide that shows the performance of fiat currencies relative to gold over the past 25 years. Remember, gold is primarily a currency. The major fiat currencies have lost between 90 and 93% of their value against gold over the past 25 years, with the worst drop being in 2024, where their average loss was around 24%. If anything, the downward trend has been quite consistent over time, except for one period, which was 2012, 2013, and 24, as you can see from this chart. Interestingly, those were the years where US public debt was being brought under control. The correlation between the growth in US public debt and the gold price is uncanny, and it makes sense. To be bearish gold right now, you must have strong conviction that we'll see a meaningful pullback in the size of the US debt, which currently stands around $34 trillion. Gold historically performs well in periods of declining or flattening real rates, with the gold price direction generally tied to this trend and expected trend of real rates. Heading into 2025, the US FOMC dot plot, released in December, displays more members shifting to a less dovish stance, with the majority of the members anticipating 50 basis points of rate cuts in 2025 versus the prior 100 basis points in the September meeting. In our view, the tariff developments are likely to put price pressure on the US consumers and potentially ignite a new wave of inflation, which is likely to be met with the US Fed pausing on future rate cuts this year, if not moving higher to combat this potential. Right now, the US 10-year bond yield is around 4.4%, with inflation expectations still around 2.2%, which translates to a 2.2% real yield, as you see on the slide. So should bond yields pull back and or inflation picks up, we could see another leg up for gold. I mentioned central banks who have been the net buyers of gold over the past 15 years. Since the outbreak of the conflict in the Ukraine, net purchases have increased significantly, as you can see from these figures, which were released by the World Gold Council just this week. And it's not China who are just China who are buying gold. It seems to be more widespread, but it's true that China and India, who are the major players in the BRICS nations, are very active in accumulating gold and have been for some years. Talking of China, you can see from this blue line, which is China's holdings in US treasuries rebased to 100 in 2025, that they have accelerated reducing the exposure to US treasuries from 2022 onwards. They currently hold 30% less treasuries on a value adjusted basis. I mentioned the stealth market. Well, compared to the bull market that we had between 2000 and 2011, where fund participation in gold moved up close to 20% of equities in portfolios, in hindsight, this was probably a clear signal that we were near the top of a cycle. This time round, the exposure to gold is less than 3%, despite gold being the best performing asset class anywhere in 2024. Usually, increased fund participation drives the gold price higher. It will be interesting to see if we indeed get greater participation by the funds over the next year or two. Just to reiterate the influence that fund buying has on the gold price, you can see from this chart that the gold price moved in step with net buying of gold ETFs since 2004, except from 2022 onwards, when this relationship broke down. And that was the period where central banks stepped in to accelerate their buy. Interestingly, we have started to see net buying of gold returning as interest rates are being cut around the world. For us, we are particularly interested in gold and silver equities, where the companies can generate significant cash flows in a high gold price environment, but they can also substantially grow the value of their business through exploration and M&A. This is the chart that was sent to us this week by TD Cowen, showing the beta of the large cap gold stocks, as well as the beta of the mid cap smaller gold stocks in different gold price environments. Usually in a gold bull market, the beta to gold that you can expect is closer to about 2 to 2.5 times, with the smaller cap shares having a greater beta, although they tend to be late movers in a cycle. At the moment, the beta for both lie around 1.5 times, with the larger cap having already rallied quite strongly, some of them. So we think it's just a matter of time for the mid-cap and developers to really catch up over the coming months. In conclusion, last year we saw a big rally in the gold price, but it left the gold shares behind. The expectation this year is that we will start to see a catch-up of those shares, even if the performance of the gold price is muted this year compared to last year. And we think it's actually a really exciting time for investors looking at the sector right now.